Hi, my name is Alex and I'm going to be presenting on Verizon Communications. So some quick company background is that it's headquartered in New York City. The sector it's in is communication services, and its industry is telecom services. Recent headlines by the company is that it recently issued about $12 billion in bonds. It's likely to spend around $20 billion on the C-band spectrum auction later this month. C-band spectrum is essentially the frequency, and ownership of it is what companies need in order to expand and strengthen their 5G services. It's also currently leading the way for nationwide 5G service right now. They spent nearly $2 billion at a recent 5G spectrum lease rights at a federal auction in September of this year. 2020 quarter earnings were beaten for a third year, strongly driven by the continued virtual operations from a lot of people and companies. Financial standing by the company is that between the years of 2017 and 2019, the stock rose about 4.6%. This is driven from higher revenues that the company is seeing. Net income margin decreased from about 24% to about 15% during the same time period, of course, dropping earnings about 37%. In 2017, Verizon did get better, higher tax benefits, and this was largely driven because of the administration's tax laws that they had initiated for that year, and Verizon saw some benefits. COVID-19, of course, has impacted this year's numbers, specifically in quarter two, where the restrictions were very high in adjusted store operations and different restrictions across states that limited their earnings potential. A quick financial analysis of the company. DuPont analysis will show that in 2017 we were having our ROE about 70%, and then started to see it drop. And like I said, our net profit margin was about 24%, and we saw it drop. This is largely because of some tax benefits that we got that were really helping out the company. In 2019, we're starting to see it pick back up. Our asset turnover is also getting a bit better, so we're optimistic that while we had those benefits and we didn't have them in the past years, the company's getting better at managing money overall. Dividend discount model that we did with the current stock price and their past trends on dividends showed that the stock is undervalued, and stock valuation based on a Gordon's growth model was about $224. So this should be a buy based on current growth rate for dividends using an average of the past years. Financial trends. So just some quick financial notes is that Verizon's cutting expenses is some of its media units that it owns, Yahoo, HuffPost, and TechCrunch. This is great because the company has to be more conservative in how it spends its money, especially within a year like 2020. Verizon earned about 1.25 per share, above an analyst estimate of 1.22. And another thing we're going to note is that increasing liquidity ratios are a strong indication of managing debt. So yes, the company is taking on more debt, but it's also getting a lot better about how it's managing its debt with its total current assets, just overall improving in its current and quick ratio. So just a quick note of that. And then the net income, as we can see in 2017, where we had about 30 in the $30 billion range, and then it dropped off, but we're starting to see it come back up. Some enticing prospects for Verizon is that in 2018 they announced a goal to achieve $10 billion in cumulative cash savings by the end of 2021. So far, it's yielded about 8.3 in savings since the program began. It's on track to achieve its target. The company's been increasing its receivables the past 2 years. This is a good and a bad, because it could be an indication that customers have trust in Verizon since they're willing to take on credit to be in business with them. But also, Verizon needs to be careful that the company's customers actually pay it. Then another thing is that the company has been taking on more debt, but this is being linked to an increase of capital expenditures. So some of the competitors that Verizon have are big ones are AT&T and T-Mobile, the ones we're looking at right here. Market cap, Verizon is leading the way. PE ratio, it also has a very strong PE ratio compared to its competitors. T-Mobile's is very high, and that's because they recently acquired Sprint, and a merger of that size typically tends to change up the PE ratio. It's not a ratio that we want to look at whenever this kind of has happened. So we also have our price to sales ratio and our price to book ratio, where we see that AT&T is actually doing not too bad, but we'll look at their EV, the enterprise value, and we'll see that they're a lot higher. They actually have less cash on hand than Verizon does. taking on more debt, which is not a good thing, of course, for a company of that size, and it's going to hurt them for an investment with 5G. T-Mobile acquiring Sprint is going to make them more competitive than in years past, so it's something we got to look at, but we're taking note of it for now. So speculation about the company is 5G is going to be very high capital intensive, and it potentially can have a lower ROI than we're anticipating. Microsoft and Verizon announced that they're going to partner to hopefully find cost efficiencies in 5G, so that should be hopefully a good indication of and increase our ROI for 5G. Disney and Verizon have a partnership for their Disney Plus service, and in November, this service that Verizon was giving to its customers for a free year has expired, and now they're gonna actually start to realize profits from it. Is definitely something that could drive up some of their numbers. And then the new iPhones are likely to drive up revenue since this is the first generation of phones with 5G capability. So we were looking at a medium-term 10-year bond for Verizon with a coupon rate of about 1.5%. And we were looking at if we want to invest in the stock or the bond. And I'm going to pick to stick with the stock. And this is because Verizon stock is currently undervalued at its current dividend growth rate with the model I showed earlier. A free cash flow to firm model valuation also showed that it's currently undervalued at an expected growth rate of about 2%. So this is so much stuff that we can't ignore that Verizon looks like it's leading 5G and will definitely have a better return of investment than a bond would. This bond is not a risky bond by any means, but the stock prospects are just too good to pass up, and it looks like it should be a buy. And these are my references. And with that, I will thank you for your time and have a good day or night. Thank you.